Good morning, ladies and gentlemen. Welcome to the GiG Software PLC Q4 Results Investor Presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time just using the Q&A tab on the right-hand corner of the screen. Simply type in your questions and press send. Before we begin, we'd like to submit the following poll, and I'd now like to hand over to CEO Richard Carter. Richard, good morning.
So, good morning, everyone, and welcome. I'm Richard Carter, the CEO, and with me today is our CFO, Phil Richards. Today we'll walk through GiG Software's Q4 and full year 2025 performance and our outlook for 2026 and beyond. We will start by reviewing our financial results, the drivers behind the numbers, and how our strategy and investment, particularly in AI and our CoreX and SportX platforms, are positioning us for future growth. Like our previous results presentations, I will begin by covering the key highlights from Q4 and full year 2025. Phil will then take you through the financials in more detail, including revenue, EBITDA, cash flow, and the balance sheet. Finally, I'll return to talk through our strategic progress and outlook, including our focus areas for 2026, routes to market, sportsbook, Spain, and AI in action, and then we'll open up for questions. So let's turn and look at our key highlights. So let me start with the high-level numbers for Q4 and full year 2025. In Q4, revenue grew 8% year-on-year to 9.5 million euros. Taking the full year revenue up 18% to 37.6 million, versus 31.8 million in 2024. EBITDA increased by 1.4 million year-on-year in the quarter to 1.5 million, and for the full year, improved by 7.3 million to 4.3 million, compared to a 3 million loss in 2024. Commercially, we maintained strong momentum, with 5 new commercial agreements signed and 6 successful launches in the quarter, bringing total launches to 16 for the year. We ended the year with a solid cash position of 9.9 million, and we are on track to deliver 4.5 million of annualized cost savings by the end of Q2 2026. I will now hand over to our CFO, Phil Richards, who will take you through the financials.
Thanks, Richard, and good morning, everyone. Starting with Q4 2025, revenue grew 8% year-on-year to 9.5 million euros. This was driven primarily by additional custom launches during 2025 and growth from our existing customer base. Adjusted EBITDA came in at 1.5 million euros, an improvement of 1.4 million versus the 0.1 million in Q4 2024, this reflecting both top-line growth and a leaner cost base. Importantly, we reduced our cost base by 0.7 million year-on-year in the quarter, despite the higher revenue, already showing the benefit of our cost reduction actions and operating leverage. Looking at the full year, revenue increased 18% to 37.6 million euros, up from 31.8 million in 2024, driven by a combination of custom growth and new launches. New customer launches in 2025 contributed 2.1 million of revenue, and adjusted EBITDA improved to a positive 4.3 million, which is a 7.3 million swing from the 3.0 million loss in 2024. We achieved this while reducing our cost base by 1.5 million year-on-year to 31.5 million euros, with underlying customer growth and new launches supporting a 10% year-on-year increase in ARR to 36.7 million at the start of 2026. This bridge shows how we moved from 31.8 million of revenue in 2024 to 37.6 million in 2025. We added 3.9 million from new partners and growth with existing partners, including 2.1 million from 2025 customer launches. Underlying growth was strong, with a 24% year-on-year revenue growth for platform customers, 21% for sportsbook, and 22% underlying revenue growth for our top 10 customers. And all of this was achieved despite a 0.7 million constant currency headwind from the depreciation of the Argentinian peso. Turning now to ARR. Our ARR increased from 33.4 million at the 1st of January 2025 to 36.7 million at the 1st of January 2026, an underlying ARR growth of 3.3 million year-on-year. This 3.3 million net ARR addition came from new customer growth and growth in our existing customer base. Crucially, around 90% of our 2026 revenue is underpinned by commercial agreements, giving us good visibility for the year ahead. On the cost side, operating expenses decreased by 1.5 million year-on-year, despite the strong revenue growth. The bridge on this slide shows reductions across marketing, personnel and other costs, taking total OPEX from 33 million in 2024 to 31.5 million in 2025. In Q4 specifically, OPEX declined by 0.7 million year on year, mainly driven by lower personnel costs, and we will maintain a strong focus on cost control into 2026 as the additional 4.5 million annualized savings come through. This slide summarizes the 4.5 million annualized OPEX reduction that we're delivering through smarter operations. Around 75% of the savings are concentrated in engineering, where we're using AI-enabled productivity and process optimization to do more with leaner teams, whilst maintaining 100% of customer delivery. We've used strategic headcount optimization, AI tools to automate repetitive coding and testing, and streamline workflows to improve code quality and speed. This is about working smarter, not doing less, and positions the business for scalable growth. This chart shows the bridge from negative 3 million adjusted EBITDA in 2024 to a positive 4.3 million in 2025. The improvement is driven both by revenue growth and a tighter cost base, with revenue adding materially, COGS remaining well controlled, and OPEX coming down. In Q4 alone, we delivered 1.5 million of adjusted EBITDA compared to 0.1 million in Q4 2024, thus demonstrating the operational gearing in the business as volumes scale. Moving now to cash. This slide shows the Q4 2025 cash flow waterfall, where we continue to reduce cash outflows quarter on quarter, and we benefited at the same time from proceeds of 11 million from directed share issues during the period. We saw a 1.2 million year-on-year improvement in operational cash flow, excluding working capital and investments, and we finished the quarter with a healthy cash position of 9.9 million at the 31st of December 2025. For the full year 2025, operating cash flow continued to improve. Our operating cash flow, excluding working capital and investments, reached 3.3 million in 2025. This includes 1.2 million in Q4, which was our strongest quarter since the IPO. This represents an improvement of around 8 million compared to 2024, reflecting both a stronger profitability and tighter working capital and cost control. Turning now to our guidance. We reiterate our 2026 financial guidance as per our trading update. We expect revenue in the range of 44 to 48 million and EBITDA of 10 to 13 million, and we're targeting to be cash generative by the end of H1 2026. The guidance is underpinned by our current ARR base, expected revenue from launches in 2025 and 26, and a steady quarterly revenue ramp through the year, supported by 12 to 14 brand launches in 2026. And with that, I'll hand back to Richard for the strategic update and outlook.
Thanks, Phil. So now I'll take you through our strategic progress and outlook, including how we see the opportunity in 2026 and beyond. So looking forward, we see significant opportunities for profitable growth around 4 key focus areas. First, expanding our routes to market. Second, accelerating sportsbook growth. Third, further capitalizing on the opportunity within our Spanish operation. And fourth, embedding AI across the business. Our first focus area is expanding our routes to market with both new and existing clients. For existing customers, our investment in technology, product, and operational improvements has led to increasing customer trust. And that is paving the way for incremental growth opportunities as we help them expand into new markets and upsell products such as SportX, DataX, and LogicX. For new customers, we are targeting operators entering new markets using our licensed and compliant platform, land-based operators moving online, media companies wanting to monetize their audiences, and lottery operators entering either online casino or sports betting, as well as selective strategic investments where they support our strategy. Now let's turn and look at how our new partner launches are underpinning growth in 2026. We delivered 16 brand launches in 2025, including 6 in Q4 alone. and we expect these 2025 launches to generate around 7 million of revenue this year. For new launches in 2026, we plan 12 to 14, with a focus on Q2 and Q3 delivery. We have more than 60% of these already commercially agreed. These launches span attractive regulated markets, including our core markets of the UK, France, Canada, and Spain, across our CoreX, SportX, and SweepX products. Our second focus area is Sportsbook, which forms a core part of GiG's offering. SportX is our proprietary B2B sportsbook solution, launched as a core component of the X Suite just over 2 years ago. Over 40% of our clients currently use our sportsbook, contributing around 10% of revenue, and we see continued growth potential as we deepen penetration here with existing clients, receive an expected boost from this year's World Cup, and target new client wins. Our third focus area is our Spanish business, where we have strong foundations for growth. Spain is an attractive market with stable gaming taxes and relatively low online penetration, creating long-term growth potential as players continue to shift from land-based to online. Around 20% of our 2025 revenue originated from Spain, making it our largest market. In addition, the online gambling market in Spain is forecast to increase at a compound annual growth rate of 7% from now until 2029, providing a very attractive backdrop. As well as having strong underlying structural growth drivers, Spain is also one of the markets with the biggest opportunity for GiG as we transition operators from our legacy Lira platform onto our new CoreX platform. Migrating to CoreX provides a more dynamic, scalable, and personalized technology stack, allowing for deeper use of our LogicX tools and faster deployment of games content and features. It will also allow us to eliminate duplication and streamline processes, and we are targeting annualized savings of around 1.5 to 2 million by the end of 2026, with around 0.7 million of these cost savings expected to be realized this year. At the same time, the migration provides significant revenue upsell opportunities through improved commercial terms and enhanced capabilities. Our fourth focus area is AI, and this slide showcases our AI-powered game recommendation engine is positively impacting player engagement. Our GRE uses AI-driven technology to personalize game configuration, suggesting the right casino game at the right time to the right player, and has so far demonstrated sizable improvements across the key player metrics when compared to players who did not engage with personalized content. For example, over a 3-month 50-50 A/B test, we witnessed sustained behavioral improvements with users exposed to the GRE, resulting in an 8% increase in average playing days per user, a 16% uplift in average monthly turnover per user, and most importantly, a 9% increase in average monthly revenue per user. So the plan now is to embed this feature into our platform for future clients and then to start to backfill existing clients. So now beyond revenue, AI is also helping transform how we operate internally. On this slide, you can see how our mobile team have been using AI tools to transform software development lifecycle and thus dramatically increase productivity. And we can clearly see this productivity impact with cycle time, which is the total time taken to complete a specific task, having reduced by 50%, highlighting the increased efficiency of the team and their workflows. We also saw the AI share of committed code going from 0 to 69% during the 3-month POC, clearly underscoring the opportunity at hand. These actions and learnings are being rolled out and are already contributing directly to the 4.5 million of annualized OPEX savings, while maintaining quality and delivery for customers. Now, looking ahead to 2026, we have a clear roadmap for AI across the business. In the near term, we'll be onboarding and training more departments, including our product teams, in the use of generative AI to not only boost productivity, but also drive faster and more informed decision-making. Thereafter, the next phase will focus on embedding agentic AI, starting with our mobile team. Through the second half of 2026, we will further expand AI-driven product features, such as our more personalized lobby experience based on our new X-Site front end, as well as extending the functionality of GiG Assistant, our internal AI knowledge base. Then, by the end of 2026, we'll have commenced the wider agentic AI rollout throughout the business with the goal of making Gig more agile and more innovative. So to summarize, 2025 was a landmark year of growth and profitability for Gig. We delivered double-digit revenue growth and a significant improvement in EBITDA, underpinned by 16 launches, creating a solid foundation for future growth. We start 2026 with good visibility on our revenue pipeline and launch cadence, and announced this week our partnership agreement with Jupiter Gaming to undertake a platform and sportsbook migration, further expanding our UK market presence following the recent launch of ITV Win. We have a clear focus on achieving underlying cash flow generation by the end of H1 2026, supported by 4.5 million of annualized cost savings, while continuing to invest in CoreX, SportX, and our AI ecosystem. We are reiterating our FY26 revenue guidance of 44 to 48 million and adjusted EBITDA guidance of 10 to 13 million. Backed by a solid balance sheet with 9.9 million of cash at the year end, the executive committee is actively reviewing strategic investments and M&A opportunities, and we remain very confident in Gig's future growth prospects. That concludes the presentation today. Thank you for your time, and we're happy to take questions.
That's great, Richard, Phil. Thank you very much indeed for updating investors. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab. But before we go into the Q&A, I'd just like to remind you that the recording, along with the slides and the published Q&A, will be available via your dashboard. Richard, Phil, you've had a number of questions from investors today. Thank you to everybody for your engagement. Perhaps, Bob, if I hand back to you, if I could kindly ask you to moderate us through the Q&A, and then I'll pick up from you at the end.
Thanks. The first question really is focused on the company's ability to support customers. Really, this highlights that the customer base has grown substantially, yet your expense base has reduced slightly. And so people are just wondering whether your customers are going to get the quality of service going forward.
Yeah, I mean, as we talked about during the presentation, it's about doing more and smarter with the same amount. So when we're looking at the cost optimization, it's all about using, as we said, AI to do things better and actually have a better performance for our customers. So it's not only going to not impact, but it actually be a positive impact for our customers, what we're doing as a business and how we're using AI to improve what we're doing, streamline processes. So you can see it already in action this year. We've stripped out 1.5 million out of our cost base whilst growing revenue 18%. And that's only going to accelerate going forwards as we manage to leverage the business, and you'll see that coming through into our margins going onwards. So absolutely, our customers actually get a better service by the changes that we're making going forwards, which should accelerate their growth as well.
I think I'd just add also on top of that, you've got to remember that we've only been a standalone business since 2024. We came out of a parent company, so there's been access to we've had access to a lot of opportunities to sort of streamline processes and to really sort of embed a different culture into the organization. So I think this is also partly cleaning up some sort of legacy cost issues. And sort of as Phil said, we've really focused on the team's performance, getting more productivity out of them. So I think, given where we are today, we have the ability to support a much bigger client base with the current cost base we have.
That's great. The second question is more so, I guess, for Phil. It's looking at the two different revenue lines, the ARR and the total revenue, both seeing quite different growth rates this year. Can you explain what the difference is, or what has driven the difference between the two growth rates, and whether this is going to continue in 2026?
Absolutely. I mean, to take the second bit first, no, we think we see the growth rates will be much more aligned to ARR going forwards in 2026. In 2025, we had a combination of, we had good underlying growth, but we also had a couple of one-off revenue streams. So, for example, there are a few times, and we talked about this previously in a few presentations, where, for example, customers maybe didn't go live in the sweepstakes market, for example, and there are then termination fees relating to that. And that obviously doesn't contribute to our ARR, but it contributes to our revenue in 2025. So our main metric is growing ARR and growing that in line with our top line revenue growth as well going forward. So that growth should only accelerate going through to 2026, but there were a few in 2025 when it's not been dropping through to ARR because there was certain non-recurring revenue that happened during the year. However, I'm really pleased with our underlying ARR growth and how our customers are growing. You know, I talked about those metrics before about particularly, you know, the top 10 customers growing by 22%. And I think that's a really strong metric for us. And if you look at what's happened with the Argentinian peso, that's obviously also been slightly detrimental to our ARR because that's pulled back my assumptions for how that customer is going to grow in the future. So the ARR growth, despite some of those headwinds, is looking really good. And we're going into 2026 with visibility over 90% of our revenue for 26, and that's recurring as well. So, you know, I'm really pleased with how that profile is shaping up.
The next question really is a topical one, one focused on AI. And there's been lots of talk in the markets recently about AI disrupting enterprise software vendors. A lot of the share prices taking significant hits. Just want to know, maybe Richard, if you could address this, how GIG's applications are positioned against this trend.
Yeah, I think that's a very pertinent question, and obviously, you know, it's a risk that everybody faces in the software industry. I think when we look at our business, I think we see obviously the implementation and the embedding of AI into our business as a big opportunity to accelerate growth and to, you know, reduce cost. Now, in terms of the risk, I think if you look at our businesses, clearly, I think with all of the regulation, the licenses and everything that goes into creating a business like ours, it sort of gives us insulation in terms of this. I think if you're just sort of focused on the sort of .com arena where there is no licenses, there is no regulation, then I think that area is probably ripe to be impacted. But I think given where we are, given the licenses, given the regulation, given the scale, and I think also if you look at this industry, a lot of it is built on trust. So for new entrants to come in, you know, has created the software in their bedroom to then sort of onboard enterprise size clients, I think is going to be challenging. But obviously, you know, it's definitely a risk, and we're obviously very mindful of that. And that's why, you know, over the previous 12 months, we've been sort of embedding AI into our business to help obviously protect us from those type of risks.
Great. And obviously, just a follow-up is that you're definitely benefiting from increased efficiency in your operations from AI. Is this in any way going to be passed on to customers in terms of pricing, or do you see any signs of that at all?
I think it gets passed on in terms of our ability to deliver more product features, to deliver more ways of allowing our clients to generate more revenue. You know, we talked today about the game recommendation engine. We're also doing a lot of work around bonus abuse, around fraud abuse. So again, giving these models to our clients to enable them to generate higher revenue, generate more money, and then generate more money to us, I think. So I think from that perspective, we sort of see it as a big opportunity because we're obviously a SaaS business and a revenue share. So, you know, the more features we produce, the better quality product we give the client, that gives them the ability to compete stronger and therefore hopefully generate more revenue and then us to generate more revenue. So I think it's sort of a win-win. We haven't, I mean, it's still very early days, but we're definitely not seeing any sort of pricing pressure, if that's what you're saying, in terms of renewals or new sort of business development.
Great, thanks. The next question really is focused on the capital raise that you guys did in the second half of last year. The question is focused on whether, and this is probably for you, Phil, is whether this gives you greater flexibility with negotiating different partnership arrangements.
Yeah, absolutely, it does, and I'm sure Richard will pitch in afterwards as well. But yeah, we've seen, you know, historically, and I think we've actually talked about this historically, like the need that to have a very strong balance sheet to go into some of these partnerships to capture a greater share of the economics. And it's not only that, but you know, say for example, if you look at like lotteries, for example, they want, you know, a really strong balance sheet. You know, maybe they will look at all of these things. So this gives us the ability to go after much larger customers, tier one customers, and not only that, but if we want to invest in partnerships, we also have that flexibility as well. You know, a few opportunities that came along in 2025 that we weren't able to take advantage of because we didn't have that flexibility with the balance sheet, with our cash position. And that will then allow us to be partners with these very, very key players in the market, and therefore share greater shared economics back to us and generate more revenue for us in the long run. Don't know if you wanted to add anything to that.
I think we've touched on this subject. I think in our last results. I mean, it gives us optionality. We discussed last time that during 2025 we got approached with certain big operators who wanted us to potentially put some capital into projects, which would have been very meaningful. We didn't have the capital at the time. And I think obviously also Phil just touched on, I think when you're starting to partner with much bigger operators, they're increasingly looking at your balance sheet, the strength of your business. And so it just gives more confidence as well. And then, Phil also touched on the lotteries. Again, the lotteries will want to see the balance sheet, and these are long-term contracts, 5 to 10 years. So I think it just gives us that optionality to be able to close those deals. And then on the sort of strategic sort of M&A and investments, I think these are around sometimes making small sort of capital investments, but for us to get a big share of sort of a future project where we would be capturing the SaaS revenue, and then also sharing in the sort of equity upside, so which would, we believe, create very material shareholder value for GiG. So we haven't done anything yet, we're still looking, but hopefully that sort of gives you some sort of background about what we're looking at there.
Great. Just another question focused on cash is that you guys said that there was going to be a target of cash flow positive by the half of this or the middle of this year. Just want to know how you see the mechanics of that coming together and what's driving that in this first 6 months.
Yeah, so it's going to be driven by two things, really. I mean, one of them is going to be the cost efficiencies we talked about. That's going to drop straight through to cash generation, and those changes have already been made in the business. So we're starting to see that flow through already, and it will be realised during Q2 to a maximum extent. So that's going to be one part of it. And the second part of it is going to be, the customers that we launched at the end of 2025 that are going to be generating cash in 2026. It's going to be the launches that we are doing in the first half of the year as well. So if you look at the revenue growth, less the cost we're taking out, that is where you're getting this dropping all the way through to cash flow. So it should, for us, that is an absolute key metric for us. So by the end of June, underlying cash flow positive. I mean, for sure, there'll be working capital movements that you can't always foresee. So when we strip that out, that's what we're looking at as a key metric for us. And that's what, myself, Richard, the rest of the management team are fully focused on. So, it's cost optimization, but also driving the top line growth, which is dropping through then into operational cash generation.
Great. That leads us to the next question, really, which is about revenue growth and what the key drivers you see pushing that up in 2026.
Yeah, I mean, revenue growth is going to come both from existing operators and from our new launches. So you've got the full years of 2025 launches. We launched 16 during the year, so we got the full year realization of the revenue from those. On top of that, you've got the 2026 launches that they're going to be driving meaningful revenue contribution throughout the year of 2026. And we expect our existing customers to grow as well. And we expect existing customers not only to grow, but also to go into new markets and look at, potentially taking our sportsbook, for example. And we're seeing a strong pipeline generation. Richard touched on earlier that we signed with Jupiter Gaming, for example, to launch this year. So there's a lot of exciting momentum. There's quite a few growth pillars that are in there. There's existing customers, there's 25 launches, 2026 launches, new markets for existing customers. So all of that put together gives us really good visibility over the year. And those are the key revenue drivers we're looking for 2026 and beyond.
That's great. And let's just focus a little bit on one of the partners that you did sign. Like you said, you just announced this week that new partnership. Just wanted to get some more details on that. Maybe Richard, you can highlight some of that.
Yeah, I mean, sure. So Jupiter Gaming is a business that has run a multi-brand strategy, incredibly successful team, highly skilled in marketing. So they've run this sort of multi-brand strategy for many, many years. They've used other platforms as well. So we're very, very excited to partner with these guys. We think it offers a very significant opportunity for us. So they'll be looking to migrate their brands over to our CoreX platform. and they'll also be looking to launch new brands. And so, yeah, we're very excited, and we're very hopeful that once we've launched in the UK, they'll also be looking to grow into some of our other European markets. So we're very, very optimistic about this client.
Great. The next question is diving into a little bit of detail for you, Phil. This is on non-recurring revenues, and just a question on exactly how that got built up or the change in it.
Yeah, absolutely. I mean, so there's a few different components within that. We charge setup fees, for example, as non-recurring revenues. So that forms quite a part of it. You've also got, as I was talking about before, there are some customers we had during 2025 that decided not to launch in specific markets. And then because we've got very strong contractual agreements underpinning our relationships, so they've then had to pay to terminate the contract, for example. So those are really the key drivers within non-recurring revenue. And this is something, we talked about, closing the gap between ARR and revenue growth. And for us, as we mature as a business, Richard mentioned, look, we've only been going on our own for, just over a year and a bit now. So as we mature in a business, we want to dial back, the setup fees but actually create better partnerships with our key customers. So, and less reliant on non-recurring revenue. So, whilst it's a component, you'll see it becoming an ever decreasing component in our business as our ARR grows, and we're then less reliant on that top bit. But that's what comprises it in 2025.
Great. Next question focuses on one of the cost-saving benefits that you guys have highlighted, which is the migration of Alira onto CoreX. You talked about this before. Just wanted to get an update on the progress you guys are making and whether we're getting more commitments from customers for the migration.
Yeah, I'll tell you that. I mean, yes, I think in terms of where we stand today, the majority of the customers have agreed to migrate. And actually what we're finding is some of the customers that we didn't expect to migrate are actually now looking to migrate. So I think probably by the time we come back in May to talk about Q1, I think hopefully we'll have a more positive narrative and story around the Spanish Alira clients. I think the most sort of promising aspect of this migration is just recently in Barcelona at ICE, meeting with our Spanish clients. They're now talking about adding new brands. So one client recently has signed to take our sports product and also to launch a new brand. And those conversations are ongoing with a lot of our big clients. And they're also now talking about potentially going into overseas markets. And I think that just gives you a flavor of moving from a legacy platform onto the new CoreX platform. It's just building more confidence with our clients. And, we've highlighted Spain today because we think that there is a real big opportunity here to not only increase our market share in Spain and drive that business, but also I think we'll start to see our Spanish clients looking to expand with us outside of Spain. Now that's more of a 2027 story, but it's sort of very, very exciting new developments within the business.
Great. And just on that, there's a question here focused on the sales pipeline. I guess they're looking for just a bit more detail on what you expect to be driving it and how it's looking compared to the previous year in terms of the outlook for this year.
Yeah, I think if you look at our pipeline now, over the last 6 months, we've definitely started to focus on bigger clients. So, I just spoke about Jupiter Gaming. We think that's a big opportunity. That will be one of our biggest clients undoubtedly pretty quickly. I'm very excited about near term. We're very close to some other deals. Hopefully we'll close in the next few weeks. So I think in terms of where we stand today, we're very excited about the current pipeline. And yeah, we're really optimistic about as we go through this year, the quality of the customers we're now targeting and looking to sign, which we think will have a much bigger more instant impact on the business. So yeah, so far so good in terms of the pipeline for 2026.
That's great. And then on a topic that hasn't been discussed just yet is on acquisitions. I think people are looking for just some sort of update on what sort of areas you're looking into in terms of technologies and markets.
So, I mean, at the moment, we're not sort of looking at acquisitions. We're just really focused on our day job of just obviously driving the business forward. We have a separate committee that are looking at certain investments, but we're certainly not looking at acquisitions as of now. There are lots of small little sort of investment opportunities, some bigger, and they will be predominantly, the focus will be on complementary technologies or products, and also geographically looking to complement our current sort of geographic makeup. So I think we'll probably be in a position in May to give a little bit more detail about that. But at the moment, I think it's still sort of baby steps, and we're still very much in the early days of that.
Great. Next question's on guidance. Looking for a bit of detail on how conservative or what risks there are in the guidance. Questions around, are there any single contracts or dependence on a certain contract coming through? And maybe how much growth is assumed in the existing clients to reach your guidance? That's trying to get a feel for what a drive.
Yeah, I'll take this. I think if you look at the presentation, I think we've been very transparent about the makeup of this year and where the growth's coming from. But if you just go through the sort of building blocks, I talked about in my presentation in terms of where we are in terms of signings for 2026. So I think we've got roughly around 90% of our, probably higher than that actually now, if you include Jupiter Gaming, depending on when they launch this year. But if they launch sort of, around the half year, we're probably, 92, 93% in terms of what we sign this year. So I would say the big delta is going to be around timing on launches. So if we miss out slightly on launches and they get delayed for whatever reason, and there are lots of reasons, then that would sort of suggest we're going to be at the bottom of the range. And if we are on time, then we'll be sort of in the middle of the range. Now, to get to the top end of the range, you would expect, because the assumptions we're making are predominantly around minimum fees. So once clients start to get through the minimum fees and start to ramp up, which is very difficult for us to predict, and that will then sort of drive you to sort of the top of the range. So I think the real outcome of this year is around timing on client launches and just how quickly our 2025 and then the early 2026 launches ramp up. So that's going to be the sort of the key deltas.
Great. Last question here, and one focused somewhat on the share price. The shares are very attractively valued right now. And the question really is around what catalysts or milestones do you see driving a re-rating of the stock?
Well, I think there are a couple of things, clearly. I think cash flow positivity, I think that's obviously a key metric for us. So I think, once we get to cash flow sort of positivity, I think the whole investment case is sort of discounted. So I think that's the real key sort of metric. And then it's a case of, we announced Jupiter Gaming, it's sort of onboarding them and ramping them up and getting them to deliver. So I think it's a case of, delivering the clients this year, launching them on time, hitting the numbers, and then getting to that sort of cash flow break even. And I think, if we do that, then I think, the rest will take care of itself.
That's great. Bob, thank you very much indeed for taking us through the Q&A, and thank you to everybody for your engagement. And if there are any further questions, we'll make those available to you post today's call. Richard, Phil, I know investor feedback will be particularly important to you both. I'll shortly redirect those on the call to give you their feedback, but perhaps, Richard, just a couple of closing comments, and then I'll send investors for feedback.
Yes, I'd just like to thank everybody for joining us this morning. And I'd just like to say a big thank you to all the GiG employees for going above and beyond in 2025. And we're really looking forward to updating you on our Q1 progress in May. So thank you for listening this morning and joining us.
That's great. Richard, Phil, Bob, thank you once again for updating investors. Please ask investors not to close this session, as we'll now redirect you for your feedback. On behalf of the management team of GiG Software, we'd like to thank you for attending today's presentation, and good morning to you all.